Hi, and welcome to the Amplify Investment Partner Hedge Fund session 2. It's the second one in the series. The first video was about an overview of the hedge funds. What we're going to be doing today is to focus a little bit more on the fixed income hedge fund strategies, looking at the return profiles of the strategies, how to use these hedge funds into a portfolio, and then what the overall benefit is of fixed income hedge funds. So before we start and go into the strategies, important to know is that what we look for in hedge funds is asymmetrical returns. Now, what does this mean? Is essentially a pretty simple concept of being able to capture as much of the upside as possible when markets are running, while at the same time having the ability to protect when markets are falling. Now, it's important to note that different managers and different mandates will be better or worse at protecting the downside and capturing the upside. And it's important for you as an investor to understand the underlying portfolio and what the mandate is, what the outcome is that the manager is trying to achieve, to understand what your clients' needs are and whether it is in line with the manager's portfolio construction. Looking at the difference between traditional managers and hedge funds, the real main difference is really the unconstrained mindset that a hedge fund manager brings to the party. If you think about, a traditional long-only manager, he will look at a basket of securities. Essentially, what he's going to do is he's going to buy those securities that he likes, that he thinks is going to give him growth over the long term, and simply just not invest in those securities that he doesn't like. As opposed to a hedge fund manager that will look at the same basket, will buy those securities that he likes and believes is going to give him growth, but he will also short those securities that he doesn't like. And that is typically why managers will say to you in a hedge fund environment that they have the ability to generate returns where the markets are going up and down, and that is simply because of the ability for them to be able to short sell in the market. Over and above the short selling, they can use leverage as well as derivatives. And maybe important just to stop here about derivatives and the difference between long-only managers and hedge fund managers when it comes to derivatives, because you may well say to me, but a long-only manager also uses derivatives. The difference is that in a long-only manager can only use derivatives to protect an existing position that they have in the portfolio. So as an example, if a manager has NASPERS and he's got a pretty high exposure to NASPERS, typically they would put a derivative instrument over the NASPERS position, which in case the share falls more than a certain percentage, it'll protect and you won't participate in that fall in the market. When it comes to a hedge fund, they may outright take a position in a security through a derivative. Over and above that, both vehicles are well regulated. And typically the underlying investments would be in the same instrument that they get their returns from. Then if we just look at the different strategies for hedge funds, the four main strategies that we look at is the long short equity. In the third series in the webinar, we will look a little bit more in depth into long short equity. Commodities, the difference with commodities compared to traditional thinking is that, in a hedge fund, what they do is they use the soft commodities. So typically looking at things like sugar, coffee, corn, and therefore looking at weather patterns and how those weather patterns may affect the crops and ultimately affect the prices. Multi-strategy being really a combination of the different strategies, but today we're focusing on fixed income. And fixed income really looks at short-term mispricing that happens within fixed income instruments. So if we can just use an example there, if you look at the yield of a 2-year bond and a 10-year bond, there may be a long-term average that the difference between those two yields would be 10% over a period of time. If a hedge fund manager wakes up in the morning and he sees the differential between those two bonds has now blown out to 4%, a hedge fund manager will look at the differential, and what he'll do is he'll go long the cheap or the inexpensive bond, and he will go short the expensive bond. Typically, then what he's looking for those two bonds to do from a yield perspective is that the differential will go back to its long-term average, so back from 4% down to 2%. It then doesn't matter which one of the bonds are performing better or worse, because he's short and he's long the two different instruments. And as those yields go back to the parity, to a 2% differential, that is how returns are generated for clients. Over and above that, if they believe that interest rates are going to go down, they'll go you know long nominal bonds. If they believe that interest rates are going up, they'll go short those bonds. And similarly with inflation linkers going long if they believe that inflation is going up, and going short if they believe inflation is going down. Just looking at a graphical representation again of asymmetry return and what has happened in markets. And so what we've done in this graph is, at the top line, what we've got is we've got all the positive returns of the all share index over the last 5 years, and then the bottom graph is basically the negative returns of the all share index over the last 5 years. If we then overlay onto that the different hedge fund strategies, what you see is typically that asymmetry return graph that we spoke about in the beginning. So if you look at long short equity as an example, it is not going up as much as the all share index in those positive periods. But importantly, if you look at the negative periods, that the long short equity has protected very well. Looking at the red line is the multi-strategy. And then if you look at the fixed income strategies, you'll see again that they've actually performed positively in all those negative periods for the all share, capturing also on the upside, but that your returns from the fixed income managers is typically a lot narrower, giving you a lot more certainty of return. If we then use exactly the same graph and we use it on the all BE or the all bond index, again, you see a very similar outcome for the fixed income manager deriving most of its returns from the all bond index. I think importantly showing the negative returns from the all bond index versus if you look at the fixed income hedge fund, how in those negative periods they were still able to provide you with a positive return. And then again on the top line giving you the upside participation. And essentially that is proving in practice what we talk about when we talk about asymmetry of return, being able to protect on the downside and being able to capture as much of the upside as possible. So importantly to also understand is that not all the hedge funds are created equal. And so what we're going to do here is essentially just look at the different fixed income or the different hedge fund strategies. So what we do in this graph is basically to divide the returns from the markets over the last decade into two separate 5-year periods. So the first 5-year period is then from 2010 up to 2015. And typically what we saw over that period was that the all share index had done relatively well. That was the recovery post the financial crisis. And we've got the all bond index. And then you'll see that the long short equity category did better than the all share at lower levels of risk. You've got multi-strategy and then fixed income on the far left, giving you returns in between the all B and the all Z, but at much lower levels of risk. It is important then to look at what happened in the following 5 years. And as we all know, that was the low return environment that we went into. And so typically when the all share, you'll see that the all share, the returns went down significantly with increased risk. Notice what happened with the long short equity. Also, the returns were much more subdued and also the risk had increased. Important here, and the reason for this is that typically how these managers work is that they've got a net long position to equities. So when the returns from the equity market, so the beta goes down, typically what you will find is that those strategies will also be under pressure. Something similar happened on the multi-strategy, but if you look at the fixed income strategies, you'll see that the returns actually were very much similar in the first 5 years as the last 5 years. They went up slightly with slightly higher risk. And the returns from the all bond index also went up over those 5 years. So just looking at different fixed income strategies, and this is actually an outline of the four fixed income managers that we have in our portfolio, is that we look for managers that derive their returns from different areas of the yield curve. So typically, your one manager is playing on the short to middle end of the curve. You've got another manager that plays from the middle to the long end of the curve. Then we have a manager that takes small incremental positions across the entire yield curve and just looking for incremental gains in each one of those positions. And then a high conviction manager that also plays across the yield curve. What this then provides you as a client or a potential investor is that because the returns are generated from different areas of the yield curve, you get a uncorrelated return even from your different fixed income managers. So in conclusion, the reasons for looking at hedge funds and fixed income hedge funds in particular is really the asymmetry of return, being able to protect you on the downside, being able to capture as much of that upside as possible. Important to note that you need to do your homework when looking at the appropriate hedge fund for you to invest in, to understand the overall portfolio that you're going to be blending them into. It is an alternative asset class. It does give you a uncorrelated return versus equities and bonds. It is a wonderful diversifier in those environments. And then lastly, really that the fixed income managers, as opposed to your long short equity managers, are giving you a relatively narrow range of returns, giving you more certainty given different markets. I'd like to thank you for joining us for this session, and look forward to seeing you on the last session on long short equity. Thank you very much.